One of the most notorious months in the investing calendar has arrived with a bang. You've likely heard the expression, sell in May and go away. And after all that's happened this week, you may be tempted to act on it. But I can almost guarantee you've never heard of the earth-shattering Wall Street event headed straight for US stocks in less than 60 days. Now, the date is all set. It's coming. 63 funds are actively preparing to send shockwaves through over $10 trillion of American wealth. And you have mere weeks to get ready before a wave of volatility crashes over half of the US stock market. My good friend and brilliant forensic accountant Joel Littman is stepping forward to help you protect yourself and get ready on Wednesday, May 10th. If you have any money in IRAs, 401ks, annuities, pension plans, stocks, or bonds, I urge you to give Joel's warning your most serious consideration. It couldn't be more important to protect your wealth in the weeks ahead. Again, Joel will go live on Wednesday, May 10th with all the critical details. Head to 2023warning.com now to make sure you're on his list for updates. Again, that's 2023warning.com. Don't miss it. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show here on Stansberry Research. Well, just when there was talk that the energy crisis in Europe was coming to a close, German utility E.ON SE now warning that Europe may not have seen the end of turmoil in its energy markets, and the situation could still take a turn for the worse. Joining us today is Ford Nicholson. He is the co-founder and strategic advisor to MCF Energy. He also has more than over 30 years experience working in the energy sector. Ford, nice to meet you. Welcome to the show.
Thank you, Danny, very much. Glad to be here.
Yeah, well, lots of ground to cover with you today. Obviously, want to talk about what Europe should be preparing for this winter. I know we're still in the month of May, but it will come sooner than we think. Now, I found it interesting that the headlines we had been seeing recently was that, okay, the energy crisis, we saw the worst of it, it's in the past. But what's the real deal here, Ford?
Europe is facing a pretty significant crisis, which in many respects was of their own doing. And I don't think I need to dwell too much on that, except to say that it's been, in the headlines of the press that they have been pushing for a renewable energy strategy, and pushing distance themselves from oil and gas, except for what was a cheap provider, 50% of their production coming from Gazprom into Europe. And that reliance set themselves up for a real problem. Today, the issue is going to be, in the near term, after getting through this winter by cutting domestic demand and importing massive amounts of LNG and a relatively warm summer, they've gotten through it. But now going forward, it's going to be problematic. They have, in effect, put themselves in a soft footing for their industry. They've cut massive amounts of gas into BASF to all the engineering and construction material supplies side. So they have to come up with a solution. And going into this winter, they don't really have a solution yet, except to import much more expensive gas from North America primarily.
Right. So to that point, help us explain, because, they basically were able to weather the storm, as you said, mostly due to weather. We had the huge drop in oil prices obviously helping. They got much of the gas from Norway, the shale fields of Texas and Qatar. So what about those sources? Why can't they just stick to the plan here? What will change?
Well, so I think first of all, let's just remind ourselves of 50% of the demand. When you think about a domestic economy or a country, it's all about balance of trade, and one of the biggest inputs for every economy is either domestic supply or outside supply of gas or power. So in the case of, let's use Germany as the primary example, it's the sort of dominant economy in Europe and had all that gas coming in. They now have to face some solutions which are difficult. Importing gas from Qatar, importing gas from Australia, importing gas from the United States is expensive as hell. So the issue that they have to address is how do they offset that? And the wind and solar planning is not going to work for the kind of volumes of industry and constant baseload power. So they've shut down their nuclear power as well, which is a whole another sort of path of discussion. But the net effect is that they need to have that power stabilized with a price that the economic output of Europe can provide with and put up with. Today, it's a very difficult place to be. I think that really, when you sort of boil down to what is the potential solutions, one is to produce your own domestic hydrocarbons as much as you can while you're making the transition for energy. The hydrogen discussion is also a very, very difficult one for them. They talk about it a lot, but you have to understand that hydrogen it takes power to create the hydrogen. It's a very difficult product to create. It takes a lot of energy to create it. And most importantly, all the infrastructure with respect to the hydrogen discussion has to be replaced. So pipelines to move hydrogen, it doesn't work. Hydrogen is a very, very small molecule atomically, and it creeps through the pipeline, through the steel itself, and makes it brittle and breaks down. You can't have leaking pipelines throughout the entire Europe continent. You have to replace the entire pipeline network for that. Nuclear as a baseload power is probably the best solution for them in the longer run for baseload backup. But for their economic output, they've got to produce every bit of hydrocarbons they have while they go through this transition. So the expectation is that Europe is going to fight through this transitional energy step much faster than everybody else because they don't have much power. But what local domestic power they have or energy they have, they need to focus on and develop.
Which country in the EU do you feel has stepped up the most that they're looking within for solutions?
Well, I think the predominant amount of hydrocarbons in Europe is coming out of the North Sea. So it's Norwegian gas, it's Dutch gas, which is being shut in. There's German offshore gas and onshore gas. Britain has, of course, the gas off the North Sea itself, but it's also been declining for a long time. The only other real supply that I have touched on a couple of occasions is from North Africa. Bringing in supplies of gas from the North Africa across the Mediterranean and into Europe. That's the only other supply side that they can have. While again, they go through this sort of 7-year, $5.3 trillion conversion to renewable as best they can.
We saw how European governments stepped up and greatly allocated support to help households through the crisis. Are we going to continue seeing that support, or what are you hearing from government policy side of things?
I think that's a conversation you spend a lot of time on. The printing of money to solve this kind of an issue on energy. It is only going to last for a certain period of time. Basically the support and financial sort of washing of money to carry all these are called the retail and industrial sector is going to be too difficult to carry for too long. They have to come up with a solution, which is domestic as much as possible. The LNG import game is very, very difficult. I think at a broad level, I think there's been some conversation about this, and I think the really big risk of this winter, the one part that we need to really be aware of, is that as China's economy has begun to wake up, it hasn't gotten going as fast as we thought it would, but North America was much the same. It sort of stop and start after COVID. China's waking up. And all those excess LNG cargoes that were not absorbed by China because it was still in COVID last year were stacking up against Europe, and Europe had excess gas to be able to offset the Gazprom gas. They had all these ships piled in, were parked offshore, and were allowed to deliver gas into Europe only because they were force majeure and were not able to be supplied to China. Today, as we go into winter, China's going to take all those cargoes back that they booked for 20 years. They're going to take them all back off the table, and there's not going to be enough gas for Europe again. So right now, you've had this warm winter. The inventories have piled up. Gas has dropped off in Europe. Everybody said, okay, we're all settled down. But even because that price of gas is low, all that's starting to be reabsorbed by industry again. And by, I would say, late August, early September, inventories will be very low, and Europe's going to hit a bell. Now, nobody can predict the weather for sure, but we got away with a lucky one last winter. They might get away with another one this year. But if they don't, and that gas is not available because those ships have gone back to China, you've got a huge problem on your hands.
Exactly. So I want to dig a little deeper there, because I think a lot of times we throw out these words like crisis and huge problem and whatnot, but I really want you to paint a picture of what it means for the European people. I want it to become real for the people watching this, of what it means if they can't, if they can't afford to heat their homes. What does the landscape of Europe look like?
I think let's get right to macro. I mean, I think at the end of the day, if they are unable to fuel themselves because there is a jam up in the system, then I think it folds right to the Ukrainian war. They're going to have to settle as quick as possible because they need to get this back online. It re-empowers Putin. He can rebuild his military again, and it puts everybody in a very, very dark and difficult position. I think Poland in particular is going to be in excruciating pain if they see that there's a forced push by the public at large to come to a settlement to get the energy back online. The nuclear power systems are shut down. The gas is not contracted; it's all contracted over to Asia. They're going to be in a really difficult place. So I think for the domestic and the average person on the street, they need to be really aware that there could be a very difficult stretch ahead. And winter by winter, probably at least this one, and maybe one more winter again. And that means unemployment issues. That means it means inflation. It means all sorts of other issues that relate to them having to print money to get out from underneath this problem.
Ford, like I said, you've been in this sector for over 30 years. Would you say that this is probably one of the most critical times you've seen in your life?
Absolutely. In my lifetime, I would tell you, I spent a couple of years in Europe in 2010, 2011, 2012 when Nord Stream 1 pipeline went on stream. It was pretty obvious then that there was going to be a difficult period ahead for Europe if they were reliant on one source of energy. Japan and Korea, these other countries, parts of Asia, they only get 10 or 15% of all their power from any one country, no matter how stable a country it is. If Australia is providing unlimited energy to Asia, Korea and Japan will only take 10 or 15% from one country, so they don't find themselves reliant. They've put themselves in a very difficult position, and it's sort of score your own goal moment for Germany, also shutting down their nuclear power. It's very difficult to watch Europe sort of turning into a slow museum piece for the rest of the world, and it needs to be resolved in any way possible.
And I know, getting back to your main point, that they have to look, within, that they need a domestic solution. Right. Are they ramping up fast enough for this?
I think that's where the real opportunity lies, actually, to be very frank. I think the opportunity is over the next 2 years. There's no doubt they're going to have to lean into their domestic supplies of hydrocarbons, and that means oil and gas both. I actually hasten to say, as much as they don't want to do it. To give you an example, Germany is now mining monster volumes of lignite coal. It looks like something like the tar sands in the middle of Germany, where they're mining these operations and moving 17th century villages out of the way. They're literally disconnecting the churches and the stop signs and moving the whole villages out of the way in order to mine through these places to keep the power on. So I think for the next 2 years, there's going to be a lot of volatility and there's going to be an alpha. There's a value to a trade that is a domestic gas supply within Europe. I think North Africa, Europe, North Sea, there will be producers that provide tremendous amounts of cash flow off the back of their domestic assets, because at the end of the day, these countries need to manage their trade balance. And if they're say, oh well, it's fine, we'll buy LNG from the other side of the world at 3 times the price, it's terribly destructive.
Well, I saw, just talking opportunity, I saw some countries like Morocco, with big ambitions to produce solar and wind farms, and move that energy to Europe. Yeah. What do you think of countries like Morocco trying to step up here? Do they have a shot? Absolutely. I think again, I think there's a lot of, get it back into sort of the industrial world and how the Western world is putting their case of pushing carbon capture and storage and more sort of stringent terms of support for the CO2 emission issue. And so North Africa as a place deserves a chance to provide these supplies. Electrical power from Morocco makes a ton of sense, right? Bring in as much as possible. It's also another spot, bring pipelines closely back into Europe. So if you can bring in natural gas, bring in electricity from North Africa, it makes a lot of sense. And in fact, you could consider hydrogen from those kind of places. That's where you've got enough energy that you can actually produce the volumes of power that you could do for additional hydrogen power. Ford, I'm curious to get your thoughts on oil prices. We've seen the sharp slide in prices, which surprised markets, but some experts I'm speaking to now are telling me that they're confident we're seeing a bottom. What's your take on oil prices?
I think, there's for the rest of the world, you saw Saudi make a cut on the OPEC number. We saw oil bounce up to $80 again. They wanted to support the sort of $75 to $85 range. However, I think the banking crisis in the U.S. and China's not picking up quite as fast as everybody thought. There's a concern of demand side. So demand softened up the price of oil and gas. There's a floor to it, though. And the floor is somewhere around $60. It could have got to 50, but I think $60, $65, because the strategic petroleum reserves in the United States, you've had Biden doing his best to try to control inflation by dumping out oil out of the strategic petroleum reserve, which is about 600 million barrels. He's whacked out more oil than anywhere else than any time in history. So he needs to buy that oil back. Right. So as oil drops below 70, if it drops below 70, which it did the other day and bounced right back up again, the SPR is going to start buying that oil back. So Biden was tempering inflation by unleashing oil. As oil went through the roof, he started unleashing oil out of that system until he got the Saudis to start producing more oil, and then he's been able to slowly back off. But now he needs to refill that reserve. It puts America at the same kind of dangerous place as Germany if they don't have that reserve in place.
Well, that's a really good point, because I know we were focused on Europe, but, bringing it back here to North America, how's the situation looking here?
Yeah, so the two parts are the oil and the gas. So on the oil side, you see this floor of 60, 65 in my opinion, is where the Americans start buying that oil back, a million barrels a day plus, just to replenish the system. On gas, natural gas in North America has a huge surplus right now. It's got about 500 BCF of excess gas in inventory right now. So gas is going to remain soft and be a driver for keeping, I think, power and generation going in North America. But then also the limitation, though, if I may, just is the idea that cheap gas can get to Europe. And there's a dynamic equation there is not as easily put together, because you need to build LNG plants to move that gas. And there's a limited number for the time being.
I'm curious to also get your thoughts in terms of payment for oil. I mean, we started seeing those headlines emerge last year when Saudi Arabia considered accepting the Chinese yuan instead of dollars for Chinese oil sales. Can you talk to this movement of not using dollars for purchases?
Yeah, I think it's probably the largest volume trade you have out there, Danny. Is this energy trade, whether it's oil or gas or what have you, on a global trade basis, and it is super critical. I mean, I remember Saddam Hussein. I think the last public statement he made was, "I'm going to start selling oil. I'm going to trade oil in rubles or something else rather than dollars." And the next thing you know, he was deposed. I would say do the same thing. I mean, there's two very extreme sides of thought. One is that North America and the dollar, it will remain the dominant trade product. And we talk about the SWIFT trading platform and all the other stuff. But there is definitely there's polarization happening around the world. And so China, Russia, other countries who just want to break that dollar down, so there's not that mechanism that can weaponizing the dollar through the SWIFT trading system. They want to have some other form of trading product, whether it's the Renminbi or a Bitcoin or some other version of trade. I see that beginning to happen in the oil market, and when it hits some kind of a critical threshold, I think that's really the beginning of a problem for the U.S. dollar.
De-dollarization.
Yeah, I think that's you're going to see it in the energy market before you see it anywhere else. If it starts happening in the energy market, that's the bellwether. It's not going to be corn or cars or computer chips. It's going to be oil, right? That's the biggest liquid product moving around the world on a daily basis.
And, if it's something obviously out of our control, it's going to happen if it's going to happen. How should investors be positioned? What should they be thinking about? How do we prepare?
Yeah, I think you have to step back on how you're actually trading the actual product itself. And look at just the volatility of the hydrocarbon price in whatever denomination it is. I wouldn't hazard a guess on how to prepare for that, sort of how you divide up a portfolio of positions. But I think the energy investment windows, there's going to be very, very stark and clear places to invest in energy in different parts of the world at different periods of time over the next 12 years. I just think this is an epic moment for energy. The next dozen years, as companies and countries try to change and convert their systems, Western world putting much more restrictions on it with carbon capture and storage, etc.
Yeah,
it's going to be difficult. Each continent is going to have its own battle with energy, and it's going to. I think if you really dwell down on it, we can talk about many things, but truly, energy is where the rubber hits the road to keep an economy going, to keep a country moving. It's not the currency. It's not food. Food. Everything comes from keeping the energy and the lights on, and so keeping an eye on that and looking at the differentiation between each of these continents is going to be super critical. And I think a lot of money will be made by following this with a lot of clarity.
Really good thoughts, Ford. And just to wrap on this, for investors watching, for those who have never been exposed to energy before and they want to start investing in the sector, given the fact that there is a great window of opportunity here, as you've laid out, how do you start the groundwork? I mean, how do you know how to invest in energy? Where do you start? Where should you be looking? How do you do it? I know it's a loaded question.
That's a big one. I'd save that for another time. But I would tell you that I think you need to diversify. Let's start with that. Nobody's going to get this exactly right. You're going to be in the renewable space. You're going to be, I think, be in the nuclear space. You're going to be in the oil and gas space. And then you're going to break that up over what's going on in Asia, what's happening in North America, and what's happening in Europe. So divide those three up and look at it through the lens of where can I make investments, and at broad scale, either very narrow shots where you think you see that there's a jam in supply or demand, but I also think right now, for example, all the green energy product has been massively overpriced. There's a tsunami of money. There's no specialist money trading energy anymore. They're all generalist funds who are trading shares in Costco, let alone or some other retail product versus energy. They're not specialized in energy. So ETF money, broad general money has misplaced its positioning on energy. So I think right now, on a weighting basis, I would be more along hydrocarbons than I would be renewables for the moment, right? Until there's a break. And I think renewables there's private equity money, there's walls of private equity money that want to play in the renewable space. The new IRA Act in the US has got that going. Europe is stumbling all over the place. So there's gaps in places to play. I think you need to be dynamic. It's the most important part.
What about all these carbon credit companies we see popping up?
It's an interesting conversation. There's all sorts of ways to do carbon offsets, but I think you're going to see whether it's mining companies, whether it's oil and gas companies, industrial output companies, they're all going to be stepping into that space. I think regulation and sort of transparency about what you're actually buying is super critical. I think at the very least, buying offsets with regard to nature-based carbon credits are probably the easiest one to stare down. But there's a lot of shenanigan players in the space. So I think what's important is to make sure that you buy
players.
Well, what I would say is that you need to make sure that you're buying true carbon credits that you can truly offset with your balance sheet at an economic at a public company level.
That's sound advice. Last point, I swear. I'm really fascinated by this conversation. There's been so much talk about the opportunity for silver, obviously, in solar. Any thoughts?
So Europe's construction, North America, and China's construction of solar, what materials each of these dominant areas can actually pick up to make the products? Because a lot of these continents don't have the right supply side of materials. They're going to come up, I think, with unique solutions about how they can develop their solar business. Same with their wind terminal and nuclear systems, whether it's third or fourth generation nuclear power to natural gas. Everybody needs to concentrate on the variations that make sense for them and where they have the supply side of materials. So I'm not an expert in solar, but what I would tell you is that you need to look down the sort of barrel of what can America make with its own domestic materials, same as Europe, same as Asia. And that will be the driver for it.
Ford Nicholson, MCF Energy. Thank you so much for stopping by and joining me today. Great conversation. Thank you.
Thank you for your time, Danny. Have a good day.
And thank you for watching. We'll have more great content coming your way. Be sure to stay tuned to the Daniela Camboni Show and sign up at danielacamboni.com so you don't miss a beat. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.